it's a blur. Gotta follow the data, ain't no time to err. Watch him speak now, with that Tom Crown flair. Yeah, Chairman, he's the captain of the crew. Navigating through the markets, knowing what to do. Federal Reserve's in control, making moves. Keeping that money flowing so the economy can groove. Chairman Powell, making paper every hour. Chairman Powell, he got that money power. Data on his side, watch him rise and devour. Yeah, he's the chairman of the board, making moves that empower.
Ladies, gentlemen, I am TOMPOW, super chairman of the board, and today I want to thank you for joining us at this press briefing before the FOMC, Federal Open Market Committee. As always, my remarks are my own and do not necessarily reflect the views of my colleagues on the Federal Reserve Board or the Federal Open Market Committee. Today marks a significant step in our ongoing efforts to fulfill our dual mandate of maximum employment and price stability. After careful assessment of the incoming data, the committee has judged it appropriate to lower the target rate, or I have judged it appropriate to lower the target rate by 25 basis points to 4.25%. This action reflects the substantial progress that we have made towards our 2% longer run inflation objective, alongside a labor market that remains solid but is showing signs of a more balanced re-equilibration. We will continue to make our decisions meeting by meeting, guided by the totality of the data. To provide some context of why today is the biggest, most important, historic FOMC of our lives, let me briefly review the path that we have traversed through the committee's deliberations this year, a period defined by our steadfast commitment to data dependence amid an economy that has proven remarkably resilient. The federal funds rate has been held steady at 4.25% to 4.5% since our December meeting last year, allowing the restrictive stance to fully transmit through the financial system and the broader economy. In January, our sessions convened against a backdrop of persistent price pressures and labor markets operating near maximum employment. With the unemployment rate at approximately 3.7% and monthly job gains averaging well over 200,000, inflation as measured by PCE stood around 2.7% year over year, and core measurements were somewhat elevated. The decision to hold rates unchanged was unanimous, though we noted that further favorable developments could position us to ease policy in due course. By March, the data had evolved modestly. Headline inflation had eased to about 2.6%, core PCE to 2.7%, and was supported by abating supply chain frictions and a moderation in energy prices. Non-farm payrolls continued to expand robustly, adding more than 200,000 jobs in February, while one member, Governor Waller, dissented in favor of further tightening. The consensus was to maintain our stance. The updated summary of economic projections suggested a median path, anticipating 2 rate reductions later in the year, reflecting our balanced assessment of risks. In May, real GDP growth for the first quarter came in at a respectable 2.1%, though consumer spending showed some softening in discretionary categories. Inflation readings improved to 2.4% for headline, adding to our confidence in the disinflationary process. We reiterated our path would remain tethered to incoming information, with the minutes highlighting productive discussions and sustainability of the expansion. June's gathering incorporated fresh projections, where the dot plot indicated a median expectation for easing in 2025, a more cautious outlook than earlier anticipated. Unemployment had edged up, job gains remained slightly moderated, and core PCE hovered at 2.3%. We acknowledged meaningful strides towards price stability, but emphasized that it is not yet assured. Markets reacted with a measured pullback, underscoring the importance of aligning expectations with evidence. Most recently, our July meeting, rates remained unchanged, though two participants dissented in favor of an immediate cut for the first time, a reflection of the broadening signals of disinflation. June payrolls added 150,000 positions. The employment rate stood at 4.1%, and core PCE inflation had dipped below 2.2% for the first time in some time. Industrial production was essentially flat, and household spendings exhibited restraint amid elevated borrowing costs. And as I observed them, we are attentive to the two-sided risks, but required more evidence and more data to gain the greater confidence needed for action. Turning to today, August unemployment report revealed a sub-150,000 gain in non-farm payrolls, with downward revisions in prior months. Unemployment rates had been holding steady at 4.2%. Wage growth was continuing to moderate in line with productivity gains, and headline PCE registered down at 2.1% year over year. Core measures similarly subdued, bringing us ever closer to our symmetric 2% objective. Retail sales advanced modestly, while housing softened under the weight of mortgage rates at near 6%. Globally, our counterparts have begun easing cycles, with the European Central Bank acting as China's growth began to moderate. These developments taken together have tipped the balance, and I believe the committee will see the risks to achieving both sides of our mandate as nearly in balance, warranting a calibrated step down in rates. Broadening the perspective to the economic landscape, having methodically raised rates through 23 and 24 to restore price stability in the wake of the pandemic, we have held steady to ensure those effects permeate borrowing, spending, and investment decisions. The financial markets have navigated this period with resilience, the S&P 500 advancing about 12% year to date, in part by innovation from artificial intelligence, while the longer-term Treasury yields have declined modestly in anticipation of policy normalization. In straightforward terms, the higher for longer path has successfully tempered excess. Mortgage rates have curbed home buying frenzies, auto loans have moderated demand, and credit card balances have stabilized. Yet, the inflation trajectory now more assured and the labor market cooling in an orderly fashion, this easing can support continued strength in household and business activities without the undue risk of overheating. Regarding the range of possible outcomes today, market-based measures are pricing in a likelihood of over 95% that the board will vote for a 25-point basis adjustment, with only marginal odds on a more aggressive 50 BPS move. Should we proceed as anticipated with our 25% cut, the implications are constructive. Lower short-term rates should ease funding conditions, lifting asset prices through enhanced present values, narrowing credit spreads, and encouraging capital expenditures. The housing sector may see renewed activity as fixed rates dip below 6%, bolstering construction employment. Firms could accelerate hiring, households may find greater breathing room in budgets strained by prior inflation. That said, we approach this with caution. An overly rapid pace risks rekindling price pressures, while insufficient support could imperil employment gains. The revised projections, including the dot plot, will offer further insight. If they contemplate 3 total easings or cuts throughout the year end, it would signal a supportive path. A more restrained median could introduce some volatility, and amid ongoing fiscal and trade policy discussions, we do remain focused on our statutory responsibilities, incorporating all relevant information while preserving our independence. I thank you for joining us. I'm going to turn over to our colleague in the stream room, Tom Crown.
Chairman Powell, money machine going bird.
Whoa.
Chairman Powell,
Whoa.
he ain't playing this a blur. Gotta follow the data, ain't no time to err. Watch him speak now with that Tom Crown flair. Yeah, Chairman, he's the captain of the crew.
Oh, yeah.
Navigating through the markets, knowing what to do. Federal Reserve's in control, man.
Hello, hello. Hello, hello. Who's out there? Who's out there today? Make a little noise in chat if you're here today. What's up, my friends? What is going on? Today is the biggest, most important FOMC, and I would actually like to take a second to thank Tom Powell for joining us. It has been a while since he has graced us with his presence, but he's back because today is really that important. I know you've heard it over and over and over again that they're the most important FOMCs ever, but today it really is. Today, things are going to get spicy. Ooh. I'll get to that in a second. Thank you, Blazo. He says 50 cut. I'll get to that. This is the most important FOMC for real. Markets are hinged on this cut, and it will make or break in the short term what's going to happen. We are viewing this as all but guaranteed, so any kind of curveball is going to lead to extreme volatility in markets. For instance, if the Fed decides to go against Tom Powell's recommendation of a 25 cut, markets are going to get grumpy. They're going to get very grumpy, I'll tell you that. 50% cut is on the table for the first time this year. We see that on the Fed calculator, probability calculators. I'm not pushing it for it yet. I'm not there yet, though it is looking very likely that we have a 50 BPS reduction before the year's end. And I do want to point out that we have known this on this channel. If you followed the FOMCs, you've known this. We've seen this on the dot plots. We've seen this in their rhetoric. That really hasn't changed. I want to thank you for tuning in here. I know you have an option, a choice in your FOMC viewing pleasures, and I appreciate you joining us here at the original, the OG stream. We invented it years and years ago. It's become very popular. It's our gift to the world, but I appreciate you guys tuning in here with us. Let's get to the things. Let's get these out of the way. This FOMC stream brought to you by, sponsored by Market Cypher. Sponsoring this FOMC live, we have a limited time, a very limited time offer going on to sign up for Market Cypher. 50% off for the next 50 hours. After that, it's gone. 50% off. If you sign up using code CHIRPOW50, you'll find it in the video description below, pinned to the top in the chat. Go sign up. You'll see me using Market Cypher all day, every day. Market Cypher B is probably my most used tool here for trading. Go check it out. CHIRPOW50. It's only going to work for the next 50 hours. So here in front of us, we have our typical FOMC chart. We have 3 lines here. Our stream goes live. We have this. I'll just go ahead and remove this right now. We don't need that text there anymore. There it is. Our next line. At 2 p.m., so in 15 minutes, we will have the interest rate decision published live. Why they do it this way, I don't know. But a few minutes before, we're all going to open up our Google, our tabs, our browsers, and we're going to all look for the news early. I don't know why, but they publish these to news sites. They should just tweet it, right? I think that would be the logical thing. Just tweet it out. Just like, why are you sending it to certain people? Just send it to everybody at once. It's the internet. It's 2025. We have technology now. At 2:30, for those of you wondering, Chair Powell will join us and speak. So we are still about 45 minutes away from that. In between, we have a lot to talk about, a lot to look at. There is so much going on, and really, markets are just hinging on what this man says today. This is part of Chair Powell's farewell tour. Oh, by the way, if some of you aren't familiar, his term ends in May. And while he could be renominated as the Fed chair, it is looking unlikely. Trump does not seem to like Chair Powell very much, certainly not as much as I do, and probably going to replace him. So enjoy this time while it lasts. If we get really lucky, maybe at about, 3 o'clock-ish when the question and answers start, maybe Gina will join us. Maybe that's a little hopium. Greena, perhaps on the table, on the docket. Asian Gina. There's so many options, my friends. There's so many options. This is going to be such a good day. Are you feeling the energy? If you're feeling the energy, let me know. Gina. We lost Gina, guys. Let's just take a moment. We lost Gina, and then we also are like losing Powell. It's sad. It's a big sad. But you know what? Where a window closes, a door opens. Whoever replaces Powell probably gonna get a lot of enjoyment out of them as well. Greena's amazing, but you never know who's gonna show up to these. Could be anybody. Could be a new Gina that we've never even thought about. Keep the hopes up. We have a poll going in the chat. What do you think is going to happen today at the FOMC? Will we get a 25 cut, 50 or more cut? Do you think we will have a curveball where we have no interest rate change? Or do you not know? We have over 1,100 votes on that poll. Well, we just started. Let's get that up to thousands. We're going to have thousands of live viewers here today. People still tuning in. Welcome. She's all yours. Gina's boyfriend. You get out of here, Gina's boyfriend. You and the data. You and the Fed's data. You get out of here. Get. She's mine, baby. Lead singer of Creed in the chat. What? Is that true? I don't know. The chat's going fast. I can't tell. What's up, 10 pence? Christopher, Matthew, Clap, Bob, Chemo, Crappy Tech, Stairway. What's up, boys? What is up? Are we starting? Oh, we're starting. We're getting going. If you could really quickly double check, make sure you have hit the like button on this stream. You have subscribed. You have put a message in chat. If you're new here for the first time, let us know what you're thinking, what you're doing today. Steve, I want to shout out to Steve, Optical Art. Go subscribe to him, guys. A great friend of this channel. Let me see if I can pull up his... There he is. Great dude right here. Put his link in the chat. Go subscribe to him. Great analyst. Personal friend of mine. Love that guy. Little Fox, what's up, friends? What's up? Let me see. Let me check my schedule here. Yes, the FOMC trading warning. I must go over this every time because I'm responsible. During these events, markets can get extremely volatile. I don't recommend holding or opening leverage positions during these events, during the FOMC. Very commonly, what we will see is a predictable pattern. It is predictable, but it is very dangerous to trade, where price will range in one direction. So let's say, hold up here. Let's say right now it's trending. We'll say it's actually trending up now. Trending up. This is just an example. This is just what we typically see and why it is so dangerous to trade. So we will typically see a price trend. So let's say up for now. Once the FOMC numbers or the interest rate decision is published, we tend to see a pretty savage reversal. So perhaps it crashes back down and goes to a lower number. As soon as Powell speaks, we tend to see that reverse for a second time. And it tends to kind of seek back out equilibrium. Maybe this FOMC will be different because there is actually a lot of weight going on. In the previous ones, there was very little chance of anything meaningful happening. Today, it is guaranteed that something will happen that will push markets. And really, the least crazy outcome is that we just get the first interest rate cuts of 2025. That's like the least crazy outcome. Anything else gets even crazier. So just be very careful. If you are going to trade, obviously, we have links in the video description below. Please don't, but I can't control you. But you can sign up with our exchange partner, BYDFI. Get a 20% bonus on deposit there. A lot of perks, no KYC, all the goodies. You can check them out after the live, hopefully after the volatility is over. Pulled up in front of us, though, we have Bitcoin, which we're going to be monitoring, and the dollar. The dollar, I want to show you guys a little something going on here. Why? This might drive home why today is so crazy. What's up, T-Door? I see you subscribe there, brother. Be like T-Door. Subscribe and join us. This is just another reason why today is going to be so crazy. So here is the dollar, the Dixie. You'll notice this little trend line underneath here. Zoom out. The dollar is currently teetering, literally teetering on a 14, 15-year trend line. If you connect the lows from April of 2011 to the lows of, again, April 2021, so actually literally 10 years apart, that's kind of weird. Very weird. If you connect those lows with just a normal trend line, you will find that we are on the edge. We are on the edge. We tested this trend line almost perfectly in June. We bounced. We failed to hit higher highs. We rejected from the 100 mark. And here we are back at this trend line, retesting our yearly low. And the FOMC, Chairman Powell himself, is about to speak. I cannot overestimate, I cannot overemphasize how crazy the timing and the positioning of this chart is right here, right now. And it does get a little deeper. Yesterday actually closed below this trend line yesterday. Today, we have seen what looks like a back test of that trend line. We're going to see some very spicy stuff. That I can feel it in my fingers and I can feel it in my toes. Can you feel it? But you got to knows. Ooh, wow, we only have... Time is flying. Tom Powell really... He gave us a full rundown. I appreciate that. But that took longer than I expected. Real quick things, because we only have a few minutes actually until the rate is published. We have 7 minutes, so you might as well pull up your tabs. On Friday, really quick, Friday, I will not be here. I will be enjoying myself on a very little mini vacation. I'll be back next week early. On Friday, I will be publishing the next episode in our free trading course right here on YouTube. Where are we? Here's the full trading course. They are all bangers. All of them are bangers. There's dozens and dozens of episodes now, very flushed out. But the next episode will be published Friday. It'll be on exponential moving averages, a topic I know you guys and traders everywhere follow. You use them. I use them. Make sure to watch that video. And if you haven't checked out this free playlist, check it out. It is seriously the best on YouTube. It's all free. There's nothing for sale in them. If you want to buy something, you can sign up for Market Cypher, 50% off using code CHAIRPOW for the next 50 hours, or check out joincrowncrypto.com, our premium trading group, not a signals group. Anyway, interest rate decision coming in hot here. What do we got? Bitcoin looking strong into this. That makes me a little worried, because usually we see a reversal into this, so we'll see. Close this tab. Close that tab. Give me 1 second here, fam. Just need 1 second. Oh, it's going to get crazy. By the way, is there any feedback going on with the mic? Anything? Let me know. Pickle, shoot me a text if there is. If there's not, though, don't shoot me a text. You got me. You got me. Here we go. We got 5 minutes. All right, get your tabs ready. Get them ready. Did I miss anything? I feel like I missed stuff on here. What's up, Mr. Handyman? We got a lot of new subscribers, a lot of new viewers. We have thousands of live viewers right now. Welcome to the home of the FOMC. You just missed Tom Powell. Rare appearance. What's up, Jimmy G? Chinidu, Mr. Handyman Tidor. Blazo, thank you for the super chat earlier. Sorry, I was in the middle of that. $10 super chat. Appreciate you. It says 50 cut. You guys think 50 cut? Here's my worry. Here's where I'm at. A 50 cut, I don't think is the probable outcome, but is certainly possible. Certainly possible. It's on the table. The issue is if we get such an intense cut, I think that will signal weakness from the Fed. That won't signal go to the moon. That is likely to signal the Fed sees the economy as very weak, which is maybe you see a short-term rally, right? Maybe we see this week closes green or something. But in the longer context, even as far out as just next month even, I think it signals weakness, and I think the market will reflect that. I don't believe we're going to get a 50 cut. Certainly is possible, but when you make these big cuts, like the Fed right now can come out and it can claim that it's making these cuts because its dual mandate is being achieved. They have inflation under control and employment is being balanced, and they can say we can make these cuts healthily. That would be a position of strength, a confident position to make cuts from. If they come out and say, oh, we have to do 50, that looks more like an emergency. That looks more like oh no, we're worried. And when the Fed worries, the Fed doesn't usually worry. When the Fed worries, that's not a great signal for markets. So that is where my thoughts are at. I know there's a lot of opinions going on. 50 would be a nuke, would be a stick of dynamite, perhaps. There's a lot of opinions. We're about to find out who's right. What's up, Peach? How you doing, brother? Don't confuse us with sensible arguments. Moon only. All right, moon only, boys. Moon only. What's up, battery bro? We have 2 minutes until the interest rate decision is published live, guys. If you could, open up your browser tab. Stay here on the stream. Don't go anywhere. I'm going to pull up cryptocraft.com. They don't pay me. They're just a free site. I don't know if there's anything else out there, but they are the site I like to use for this kind of crypto-specific calendar. I'm going to pull this up. I'm going to refresh this so you can see the 2-minute, 30-second countdown is live. I want everyone to pull up their tab. And remember, if you search right now, it doesn't matter what is said. You have to find something that is published after 2 p.m. So can't be published yet, or else it doesn't know. After 2 p.m., I want you to put the interest rate decision in the chat, and I want you to put the source. If there's no source, you don't win. Let's see who can do it first. Am I streaming and commenting it? You better believe it, baby. What's up, Dean? Dan? How you doing, bro? Buy everything, says Sterla. All right. Manifesting a cut. I think your manifestations will come. Crappy tech. Who has set a stop loss points? I just recommend not really trading during these. I'll be real. Just want you to know you're holding with all of us. I'm holding, baby. My spot, my Bitcoin. That's going to stay right where it is. What's up, Will? What's up, Giga Chad? Here we go. Here we are. Just seconds until the most important, biggest FOMC interest rate of our lives is live. This is huge. This actually is huge. I know, but you're used to being clickbaited. You're used to people saying it's the biggest one, myself included, but this one is literally the biggest one. And you can say until next time, but honestly, no, I think this one's bigger than next time. Unless we get a crazy curveball this time, and then next time might be bigger. But I think seriously, this is it. Hype it up, friends. Hit like, subscribe, share up the stream. Things are going to get crazy. Are you ready? Are you ready? I'm going to pull up the more assets. Let's get gold on here. Let's get stocks. We see stocks pumping. Stocks ripping already. What's happening? Do stocks know something we don't? Dollar down, Bitcoin down. Instant reversal. And the decision hasn't even come out yet. Are they front running it? What's happening? What's happening? Ho! S&P booming. S&P booming. Dollar crashing. What's going on? What's the change? We have 20 seconds. It's not even in yet. It's not. What's happening? What is even going on? The dollar absolutely dumping. Gold and stocks going nutty. Look at this volatility. I told you. I told you. Trading during this is not a great time. 0.25. I don't see a source. I don't see a source. Ladies and gentlemen, this is going absolutely insane. What is happening here? Put a source. 25 cut. 25 cut. Where are you getting it from? Who's saying 25 cut? Is it just you and me saying it? I haven't gotten it yet. My Cryptocraft hasn't updated yet. Oh, 25 cut. Cryptocraft, 25 cut. 25 spice. Spicy spice, not 50 cut. Holy shit. Let's get back on here. Gold has rallied like crazy in this 1 minute and now has reversed, giving up all the gains. Holy this is definitely one of the most volatile this is one of the most volatile decisions we've seen. S&P up what to new all-time high? Nope, just below all-time high, selling back off. The market is not sure how to react to this news. Look at Bitcoin. Holy crap, Bitcoin moving up and down 0.5% in just minutes of time frame. Gold dumping. What? Holy shit. Look at this candle on gold. We have hit a range high and a range low all in the course of a minute and a half, 90 seconds. Leverage is absolutely punished here, guys. Hopefully you're not overexposed, not in a sketchy position. Bitcoin may be showing some strength. I don't even know what to do right now. This is wild. I'm glad I didn't have any positions. Any positions looking to get filled right now. M2 supply I don't think was updated. This is absolutely bonkers. This is bonkers. I just got an alert for Bitcoin. It was like a minute behind already. The dollar is dumping, ladies and gentlemen. Gold is back to roughly where it was. Bitcoin roughly back to where it was. Check this out, though. Here is the kicker. If you were not here earlier in the episode, we pointed out this crazy trend line. I got to get rid of this on the week because you can't see it. It's right here. Oh, my jeebs. What else is moving? Holy shizzles. Holy shiznles. All right. Point out this 10-year trend line on the dollar. And just before this news, we were hovering right here just below it. Now you can see rejecting heavily. Holy. Oh my God. Oh my God. Stocks are just blasting to all-time high. Look at this. Be careful, ladies and gentlemen. When Powell goes live, we typically see these moves reverse again. Do not get caught. Do not get caught out. Gold with the craziest candle I think I've ever seen on gold. Ever. Look at this candle. 3,650, almost all the way to 3,700 in the course of not even 5 minutes. Not in the course of 2 minutes. Holy shit, what else is moving? I can't possibly look at everything. I'm going to need your help. What is the chart to look at? Because to be real, it looks like stocks. S&P 500 is absolutely melting to the upside in this news, looking to test all-time highs perhaps before Powell even speaks. What is happening? You tuned in today and you thought, I'm getting baited. I'm getting clickbaited. It's not going to be the craziest FOMC of all time. Couldn't be. Well, it looks like you were wrong. This is definitely the craziest price action we've seen. Absolutely bonkers, friends. Absolutely bonkers. Wow, I can't even zoom in. I can't even like zoom the S&P in right. Like it's just crunching. Same with gold. Bitcoin just undecided, but this does look strong. I'll give that. That looks strong. We are on the 1 minute, so don't get too crazy here. Don't get too crazy there. But damn, look at this. We didn't even have Powell speak. Think of this. We only got the cut information. The expected cut information. No curveball, no mix-up, 25 BPS cut, live, locked in, loaded, the first cut of 2025. Also, can we take a moment, ladies and gentlemen? I don't do this often. I'm going to gloat here. All year on this channel at the FOMCs, all year we have heard every month from big accounts, from whatever, interest rate cuts are coming this month. Interest rate cuts are coming this month. Every month, right here, you have heard us say, I don't think they're coming this month. And we gave the date. We said at September's meeting. Since the beginning of the year, I have said I think the cut will come in September. Just take a moment. It's September. Wild times. Don't get caught up. Don't get caught up with the hype, man. That's what this channel's not about. Although today is kind of hype. The FOMC's right, but we like to stick to the data. We like to stick to what's happening. We don't want to lie to you. I don't know. I have trouble with it. I have trouble lying to you guys for clicks. If I was better at it, I'd be better at YouTube probably. Whew. Dollars down. We have 25 minutes. What a there's only even been 5 minutes now. Holy shit. Holy bonkers. Crypto Face, the man, the myth, the legend, right here with us. Repping our sponsor for the FOMC live stream, Market Cipher. You can see them in the video description below, pinned to the top of the chat. You will see me using Market Cipher Live as I do every day on our live streams. It is my go-to indicator. Check out Market Cipher. Use the link in the video description below and use the limited time promo code TOMPOW50 for 50% off. Very limited, 50 hours after that it's gone. Sign up now, don't wait, do it now. What's up, Kane Ria? What's up, Z Pitts, Mr. Risk? Who else is out there? Infinity % rate cut. Oh my god, did Powell just make a cut? We just got the cut news. 25 BPS in, locked and loaded in markets expectations, and we just had some of the craziest, most volatile FOMC price action that I've ever seen. This is wild. If you don't think it's wild, open up gold. No, this isn't gold on a daily or whatever time. This is the 1 minute chart. Look at this 1 minute candle on gold. In 2 minutes, not even, we saw gold trade down over 1% and up over 1.3%. Now right back to where it was. What happened here? Leverage positions just got wrecked. Targeted that recent low of today, wiped out that long leverage, I would say. Baited in some short liquidity, pumped right back up. This is This is wild. I don't think this move is over. Do not go anywhere. Stay here. The spice is just starting. Powell has not even spoken yet. The dollar is melting. The dollar is crumbling in real time in front of us. Holy. Oh. Why can I not just get rid of... Dude, TradingView, stop changing stuff. There used to be a button that said show text. Now it's not here. Stop changing stuff. Get out of here. The dollar absolutely melting. This is bonkers. In our post-TOMPOW warm-up, I showed you guys the trend line, the 10-year, 15-year trend line on the dollar, how we were hovering. I thought we were underneath it. It feels like it moved a little bit, right? I don't know. Either way, doesn't matter. We were hovering on it, above it, below it, doesn't matter. The interest rate cut, which was expected from markets, sent this tumbling. I know it doesn't seem like a big move. It might look like it here. Not even 0.5% for the dollar, bro. The dollar in the course of 6 minutes, that is insanity for volatility. If we zoom out, I doubt we see a candle that is anywhere like this candle. Maybe kind of like this back in September 5th. Kind of. Bro, this is insane. The dollar is melting. I'll show this trend line real quick again. If you missed it, anybody can understand this analysis. 2011 to 2021. 2011, 2021, yeah. All the way to today, right before the interest rate was out, we were right here, 96.7. We have officially broken a new yearly low. It's not even just a yearly low, multi-year low. Last time the dollar was this low was all the way in February of 22. We were well above the trend line. Here we are. Where is the dollar going next? Valhalla, apparently. Valhalla. Dollar not signaling strength. Dude, this is insane. It's actually insane. Gold at new all-time highs. Holy shit. I wish every day was this exciting. This is special. Check this out. S&P reaching up to all-time high 6,626 set yesterday. Now selling back off. Of course, it's now selling back off. Of course. Gold all-time high right now? Question mark. All-time high right here today into the FOMC. Gold at its highest point ever. Literally off of the interest rate cut. 3,700 and change. And it's holding on. Careful though. I'm going to warn you one more time. I know it's getting tasty. I'm itching to open a trade right now. I'm like, ooh, this looks so good. Oh, it looks so nice. When Chairman Powell speaks, we typically see price reverse again. Be very, very careful. Do not get caught. Do not get liquidated today. Let's keep the good vibes going. Don't get wrecked. So much fun watching noobs meltdown. I know. It's like the best part of it. What's up, Mako? What's up, Triple? Moon Raccoon, you're here from the beginning. What's up, bro? His speech is going to be fire. People are losing it, Steve. Let's go. Let's go. It was already known that we would do this. You know what happened is I think market participants started saying, well, we're going to get 25. We're going to get 50. The expectation continued to grow. Reality didn't reflect it. You lost it. I'm losing it. When is his speech, Giga? 2:30. It is 2:10 now. We have a few more things to go through before he goes live. I'm just shooting the shit with y'all right for this little tidbit of time we have here watching the charts, honestly, because I'm distracted. Before he speaks, we are going to, we'll do that in 5 minutes. We're going to rewatch just his keynote opening. It's just 5 minutes from the last FOMC so that we can compare the language, we can compare the word choice, etc. Yeah, look at that. On the 1 minute, we're under the trend line. On the 5 minute, we were over the trend line. I don't know, just inaccuracy. And now the 1 minute's gone. I don't know. It keeps moving. That's weird. TradingView, you're being shady. So we can compare the word choice. We can compare what he says in his keynote opener. So we'll do that. It is gambling at the moment. Always right, living up to his name. This is very gambling. Even if you pick the right direction right now, even if you're like long or short, whatever, and price continues to go in that direction over the course of today and tomorrow, you are very likely to just get stopped out right now anyway. Just enjoy the ride. Enjoy the ride with us. Keep your hands and feet inside the vehicle. Look at gold. Gold just had maybe its most volatile move. 1% down in a minute and a half, not even. 1.5% up. Guys, do not get chopped on this. I love you all too much. Do not get wrecked. Don't get wrecked right here, right now. Wait till Chairman Powell speaks and get wrecked. Gold 4-hour green dot on markets 𝐓𝐫. Yeah, I'll entertain all the markets 𝐓𝐵 requests today. There we go. That is a beautiful green dot. Kicking up, especially into that pullback. Well, I was looking at the S&P. That's a beautiful green dot on the 4-hour. Gold did just hit all-time high, and now it's retracing exactly why I said be careful. Bitcoin, where are we at here? Back to the lows right before the interest rate decision was in. We were trending up, now we're trending down. Likely to see a reversal once Chairman Powell opens his mouth. We see that very, very commonly. Wow. It's interesting, though, that Bitcoin probably has moved more than these other assets, right? Actually not. Bitcoin somehow, some way right now, the least volatile. Gold is more volatile than Bitcoin at this moment. The dollar, compared relatively, is more volatile. This is the S&P now back down, not reaching all-time high. I'm about to sneeze. Let me play a Chairman Powell song. Give me a sec.
Chairman Powell, money machine going bird. Chairman Powell, he ain't playing, this a blur. Gotta follow the data, ain't no time to air. Watch him speak now with that Tom Crown flair. Yeah, Chairman, he's the captain of the crew. Navigating through the
I'm gonna miss Powell.
what to do. Federal reserves in control, making moves. Keeping that money flowing so the economy can groove. Chairman Powell, making paper every hour. Chairman Powell, he got that money power. Data on his side, watch him rise and devour. Yeah, he's the chairman of the board, making moves that empower.
Chairman Powell, man, I'm gonna miss him. He's making moves every hour. I don't have to get a whole new song. This is a scam. What's up, Kane? Who's out there? Oh my goodness. The S&P, dude, this is why I said it looks like it's going one way, but don't get too confident. The S&P has now rallied almost to all-time highs. The interest rate decision is in, 25 BPS as expected. Blasted off on this news. And now has given up the entirety of that gain. Holy shit. Holy, wow. Wow. This is insane. Look at this hourly candle. That is not a good candle. Oh my. Oh, wow. Given up the entirety of its gain. And this has all happened in the course of 15 minutes. It has almost hit all-time high. It's come back down. Gold has hit all-time high. Now right back to where we started. This volatility is crazy. Crazy. It's highlighting just how important, just how big, just how crazy this FOMC really is. And truly it is. It is the most important. The biggest of our lifetimes. Oh my goodness. I wouldn't even count it cooked yet. We could still see all-time highs in any of these things. Oh, wow. I'm so glad you're all here with me. I guess we could close this poll. Or we should just leave it up. It's got like thousands of votes. We'll leave it up. Can I gift? I'm going to give out some memberships. I'm going to gift out these memberships. And then we're going to jump into the keynote from last FOMC to compare. So really quick, I'm going to gift some memberships for the channel. Make sure you put a message in the live. YouTube says the more you've engaged with the live stream that they're giving out on, the higher your chances of getting them. So I'm going to give you guys 20 seconds, 30 seconds. Just put a message in the chat, vote in the poll, subscribe if you're not subscribed, share the stream, click the share button, hype it up. Hype it up. And I'm going to give these away. If you want one of these memberships, put me in chat. Just put me, say me. We got 10 to give away. We'll do them in batches of 5. I'll give out 5 now. Put me in chat. Say me. You can spam. Go ahead. Doesn't matter. You can spam. Go ahead. Spam it. Spam it. Spam it up. All the spams. Let's get it out. Get it out of the system. Get it out. Let's go. Tom Crown has gifted memberships. Let's go. Me. You and you get a membership and you get a membership. What a crazy day, fam. Are you feeling this energy? I'm feeling it. It's been a while. Been a bit since I felt this. Feels good. It's crazy, but it feels good. Here we go. Congrats to all the winners. We have 5 more to give away. I'm going to give those away. Just keep hitting me. Just keep throwing the me's out there, I suppose. There we go. Memberships away. Chips ahoy. As some would say, chips ahoy. You're like, yeah, that makes sense. Chips ahoy. No, it doesn't make sense. What's up, Josh, Mohammed, Nye? How y'all doing? Welcome. We're going to now play the previous FOMC's keynote speech so that we can compare it. So we have it fresh in our minds. I'm going to turn the alert box off for now, but keep subscribing like Mohammed's doing, like Josh is doing. Like all of you wonderful people out there. Keep the hype up. We're going to blast this. Watch your I'll turn it down so it won't blast you. We're going to watch this, and then we'll just be minutes away from Chair Powell speaking. So lock and loads. Keep hyping it up.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a 1.2% pace in the first half of this year, down from 2.5% last year. Although the increase in the second quarter was stronger at 3%, focusing on the first half of the year helps smooth through the volatility in the quarterly figures related to the unusual swings in net exports. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles picked up from last year's pace. Activity in the housing sector remains weak. In the labor market, conditions have remained solid. Payroll job gains averaged 150,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and has stayed in a narrow range over the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in June, and that, excluding the volatile food and energy categories, core PCE prices rose 2.7%. These readings are little changed from the beginning of the year, although the underlying composition of price changes has shifted. Services inflation has continued to ease, while increased tariffs are pushing up prices in some categories of goods. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market-based and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to keep
Short-lived.
longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. For the time being, we're well positioned to learn more about the likely course of the economy and the evolving balance of risks before adjusting our policy stance. We see our current policy stance as appropriate to guard against inflation risks. We're also attentive to risks on the employment side of our mandate. In coming months, we will receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on potential revisions to our statement on longer-run goals and monetary policy strategy, and are on track to wrap up any modifications by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission.
Oh, is it? Oh, is it? Yeah, it probably is. That was last month's FOMC intro keynote by Chair Powell. By the way, here's 5 more memberships. Hit the me's. That was last month's to warm us up, to get us ready. In just a few minutes now, less than 10 minutes, we have seen some of the craziest volatility that we've ever seen on these. And now we are less than 10 minutes away from Chair Powell updating us on the first cut of 2025. We've got it. It's in. It's here. It's locked in. Markets have gone nuts. The dollar has just nuked. Dollar nuked on this news. One of the biggest moves in the dollar that we have seen in the time period. Some of that volatility on the dollar is crazy. Stocks almost hit all-time high. They've sold back off, and now they're a little bit elevated from where they began. Gold hit all-time high and is right back. God, I warn you guys every FOMC that markets tend to do this. They tend to move in one direction, the other direction, and they end up just right back where they are, and you just get liquidated in both directions. Whew. What a great example. Wild. Here we go. Minutes to go. I love all the me's. I love the chat being unreadable. I'm really tiny. Make myself a little bigger here. I like the chat being unreadable. Let's keep it that way. Mods, let people spam today. Let them get their energy out. It's a wild day. Let's go. What's up, Brandon Crunk? Who else is here, boys? You're here because Chris Pax told you to be here. Yo, shout out to Chris Pax. Chris Pax likes Dogecoin. I like Dogecoin. Dogecoin's good. If you guys aren't subscribed to Chris Pax, go ahead. Go ahead, subscribe to him. I know he sent you here. Check him out. Good dude. Good dude. XRP XLM, who's ready? What's going off? Have I gotten any alerts in this time? Just Bitcoin BNB. Really quick, anything happening here? Bitcoin dominance? Nah. So much spam. Keep it up. I like it. It's fun. S&P zoomed out here. You can see almost all-time high, failed high. Ethereum, not a lot of volatility. Weirdly, crypto seems the least impacted by this. Seems the least volatile. That's just unusual. In FOMC's past, we have seen Bitcoin be the most, or crypto be the most impacted, the most volatile during these times. Kind of crazy. CME gap closed. It was closed yesterday. Silver down a little bit. Weird. Solana not moving. Nothing. Is anything in crypto moving? Someone said Dogecoin. Well, maybe in honor of Chris Pax, we'll pull it up. XRP's at $3.03, exactly where we said it would be. Doge? Anything on Doge? Gina! Can I get a Gina in chat? Can I get a chirpow in chat for Gina? Chirpow. Chirpow. We will get a new chirp, no matter who replaces Powell. Right? It'll be like Chirp Bissett or something. Doge isn't moving. Dude, Bitcoin or crypto in general, just not moving. BNB, constant all-time highs. Constant. But nobody's paying attention to BNB. We are, but nobody is. What else is there to look at? I think really this is the chart to be watching. Gold, the dollar stocks seem to be the biggest movers. Holy moly. Look at that. Gold kind of looks like it's going to dump now after hitting an all-time high. Breaking range lows, all-time high. Now back to where it is, looking weak. What? I don't know. Your guess is as good as mine. Powell speaking in 60 seconds here. Let's warm it up. I'm going to refresh. Oh, I got to pull this up. Hold up. Formatting of the stream. There we go. There we go. Throw Market Cipher up there. Shout out to Market Cipher for sponsoring the stream. Use code 𝐶HRPOW50. You'll get 50% off using Market Cipher. Or sign up for Market Cipher. A limited time offer. You see me using it here all the time. A whole low time frame. Ooh. Hourly just dipping. We need a pump. We need a reversal. Oh my. Oh my. Use the link in the video description below. What's up, Nab man? Can I look at your creatine and TRT levels? You think the rate cut increased both? Yeah, just send me over a blood sample. Email me a blood sample and I will personally check it out. Now, human hormone chemistry, my new hobby. I don't know, guys. Just a minute. What's up? Christina Harafet says me. Me. You. I love the energy today. I love it. What a great time. We have seconds to go. Literally seconds. Are you ready? Are you ready? I'm ready. I'm ready. The biggest, craziest FOMC of our entire lifetime right here today. Chairman Powell himself about to join us. Here he is. What is this music? It's their music. I think you're just trying to calm us down, right? Like, take a breath. Unhype it for a second. Any minute. Fashionably late, as always. Always comes through that door also. I wonder where that door goes. Here we are. He looks flustered.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 0.25 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up, on balance, over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Gina. Everybody shut up. Just Gina. Where's Gina?
Great. Thank you. Chris
That's
Regaver,
not you, bro.
Associated Press. As you know,
not Gina.
Fed Governor Stephen Mayron has kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
Banger question. Let's be real.
So we did
Gina, you
welcome
look
a new
different.
committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
6'7".
I'm sorry. Can you,
Trip House 6'7".
you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation? Thank you.
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And you know, it's also possible that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply, and to the point where we see what I've called a curious balance. It's, you know, typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
That does not sound bullish. S&P dumping. Now below its previous lows.
Rest of the Wall Street Journal.
Dollar back
Chair
to where it
Powell,
was.
do
Holy
economic
shit.
conditions
Sure, Powell, he
and the
said a
balance
drink.
of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, you can I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that. But we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted, and how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when we feel that policy is a place and needs to move quickly to a place. That's not at all.
No.
And see
Their feed. Their feed. What?
and see.
This is their feed on their webpage. Hopefully this doesn't mean I'm disconnecting. Hold on. YouTube Fed Live. Let's see if we can find another feed, because this is choppy. What the? This has never happened. Our connection is stable.
The possibility, I guess, I'm just, labor market is trying to weakening, or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just, trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago with the fact that the forecast for unemployment didn't change?
Give me a little heart attack
Yeah,
there.
I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off. And that tells you that it's time to take that into account in our, in our policy.
So just looking at the SEP, once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts.
She could be Gina if we had to.
Yeah, so I would look at it this way. We
Don't want her to
we
be.
fully understand and appreciate that we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
Gina. I don't think she's there, but
Michael
if you
McKee from
call her, maybe
Bloomberg
she
Radio
would be.
and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your
It's all
rate
confused.
cuts wouldn't address, how do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the
Bitcoin
labor
dumping.
market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in it due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So that's what I meant by that.
Wow, the
Follow-up,
dollar is back.
Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later.
Got it.
2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean,
That's a
you're
hard
right. It
question.
does say we're going to get to 2% inflation in 2028, at the end of 28. But that's literally how you put the projections together. You're writing down a rate path, which is designed to create, over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years. But the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Keep hitting that subscribe and like buttons. Keep
Thanks so much,
hyping it
Elizabeth
up.
Schulze
Gina,
with ABC News.
Again.
The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that, though, right? We have to. Our job is literally to make sure that is what happens, and we will do that job. Right now, situation we're in is that we see
This guy.
we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass through of the tariffs into inflation has been slower and smaller. The labor market has softened, so the case for there being a persistent inflation outbreak is less, and so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them.
No way.
For a long time, our framework says that when our two goals are in tension, this is quite an unusual situation. How do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal?
The
So,
balance.
and then we think about those things and we see, as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of more neutral policy.
How concerned are you about the slowdown in the jobs market for households at home, especially younger Americans
Clearly
struggling
enough to
to land a
cut.
job?
So
Clearly
it's
enough to
an
cut.
interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment, and the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on, so that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months, and it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
There's not a single Gina. This is
Steve Leisman,
atrocious.
CNBC. Mr.
Atrocious.
Chair, in the past,
I like this
during
guy.
rate cuts, you used the word recalibration. And I wonder if you pointedly did
Lies.
not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. Let me say a word about the SEP really here. So we often point this out. What the SEP is it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year.
There she is.
And 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up
Let us
question.
not forget.
Is the dispersion in the outlook a sign of uncertainty of policy in the meetings to come? Thank you.
F-boy at your power.
It is such an unusual situation.
It is
Ordinarily, when the labor market is weak, inflation is low.
This
And
is a
when the
unique
labor
scenario.
market is really strong, that's when you got to be careful about inflation. So we have a situation where we have two-sided risk, and that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that, but it's also partly about what's the right thing to do in light of this, of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So, but we get together, we discuss, we have a great discussion, and then we decide what to do and we act. But you're right that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Hi, Victoria Guida with Politico. You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political considerations?
The dollar's getting sent.
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just everybody who is at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of, does it help or hurt this political party, this politician? That's the framework. And I think people find it hard to believe that that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now. And people they're making their arguments, and we're having a great discussion around these challenging issues. So,
Do you see the court case around 𝐂𝐴 as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
Dude, the dollar is now way higher than it started.
Thanks,
S&P
Mr. Chairman.
is
Edward
down
Lawrence,
for the day.
from Fox
Gold's
Business.
down.
So we
Jesus.
saw the preliminary benchmark revisions down 911,000.
Gina.
The revisions for June were the first negative revisions we've seen since December of 2020.
Listen
How
up,
can
this
the
is gonna be
Fed
good.
base important decisions on
Revisions.
rates and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the 𝐂𝐶EW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount, and I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies and how many go out of business, how many are founded, and it's just really hard. You can't survey for that. You've got to have a model that predicts that, and it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month, and you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data, it's just that we get it a little later.
What even is this?
for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. Shows a weaker job market coming into this year. If you had had that information, would it have changed your mind related to where the interest rates
I've wanted
should
to
be?
know this
Should there have been
also.
a cut earlier?
You know, we have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and
There's
we
no
take
reason to
appropriate
answer it,
action.
though.
And we took that
Yeah.
appropriate action today.
I want to know the answer to that too, but there's no reason to answer it. It doesn't accomplish anything.
Thanks,
and all it
Howard
does is set
Schneider
them
with
up
Reuters.
for
So,
told you so's and you were wrong.
as you mentioned a minute ago, some
Smart move
margins
not
of the
to
job
answer.
market would suggest that the slide's already happening. Black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a quarter percentage point now is going to arrest that?
Well, don't arrest it.
I didn't say that I thought a quarter point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And the market's has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter. And I think it's important that we use our tools to support the labor market when we do see signs like that. I did
That's why
mention
we're
that.
getting cut.
You see minority unemployment going up. You see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin, the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all those together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So, I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So, labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So, that's how we see it.
Hi, Stephanie Rule, MSNBC. Treasury Secretary Scott Bessent
Not a
has said that
single
the Federal
Gina.
Reserve suffers from mission creep and institutional bloat.
Older Gina.
He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
I, of course, am not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve Bank system, Federal Reserve system, and at the board. Are they the right size? We're actually going through a 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
But not an independent review?
We're certainly open to always trying to do better.
What's up, MetaRock? By the way, keep subscribing, guys, like MetaRock.
Chairman, Neil Irwin with
Smash the
Axios.
likes. Join us.
There's been
Keep
some
it
debate
hyped.
lately on whether AI is already starting to affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty around that. I think my view, which is also a bit of a guess, but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college. And yeah, there may be something there. It may be that companies or other institutions that have been hiring younger people right out of college are able to use AI more than they had in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down. And so it's probably a number of things. But yeah, it's probably a factor. Hard to say how big it is.
Thanks, Mr. Chairman. What evidence do you see of tariffs showing up in inflation?
Well, if you can take
The
goods,
slow
just
question,
sort
but-
of the broad goods category, and last year, goods inflation was negative. If you go back 25 years, that was the typical thing, was that goods inflation was, goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic, of course. Goods inflation went very high, but we had essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change. So we think, I mean, analysts have different views, but we think it's contributing, 0.3 or 0.4, something like that, to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that, the tariffs are mostly not being paid by exporters, mostly being paid by
they're only
really
paid by
the
importers. Why is it saying mostly
companies
not?
that sit between the
Silly.
exporter and the consumer.
Exporters don't pay
So
them
if you
in
buy
any
something and you sell it through retail, or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than we thought. But the evidence it's very clear that there's some pass-through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have nothing new on that for you today.
What does he mean by that? It's like if he gets put in there.
Hi, Katerina Saraiva with
States.
Bloomberg News. I just wanted to follow up on one of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues, do not think about politics. This does not enter the room. But one of your new colleagues does come from this world, right, where everything is seen through this framework of politics and of what party is being helped, and that person is still employed by the White House. How can markets and the public interpret, some of his speeches, for example, and then some of the forecasts that we see today? I mean, the median for this year was moved because of the introduction of his forecast. I'm talking about the number of rate cuts seen this year. What do you say to markets and the public that are trying to interpret, what you guys are saying?
So there's 12 vote, 19 participants of whom 12 vote, as you know, on a rotating basis. So no one voter, can really. The only way for any voter to really move things around is to be incredibly persuasive, and the only way to do that in the context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's really all that matters, and that's how it's going to work. And I think that is the way the institution. That's in the DNA of the institution. That's not going to change.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Why do you think that is, and what's your response? What's your message
He's not
to
going to
the
answer.
public?
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us, and we're not going to get distracted by anything.
These are low
I think
caliber
that's
questions.
what we're going to do. We're just going to keep doing our jobs.
He sounds tired now. Gina, one more time. Just if you call Gina, maybe she'll be there.
Claire
That's what I'm
Jones,
saying.
Financial
Claire
Times.
Jones.
Given the
Claire.
range of views expressed
Jones.
prior to the meeting, I think there was a lot less dissent today than a lot of people expected. It'd be good to know just what you think the drivers were of coming to that very strong consensus in the meeting, and also on the flip side to just explain why the dot plots are really so scattered between, someone even expecting rates to end up higher by the end of the year to 5 cuts. I mean, what were the kind of range of views you heard about, on one side, why there was so much support for a cut today, and on the flip side, why there's so much divergence about what comes next?
So I think there's quite a wide assessment that the situation has changed with respect to the labor market. Whereas we could still say, and did say in July, at the time of the July meeting, that the labor market was in solid condition, and we could point to 150,000 jobs per month and many other things. I think that the new data that we've had, and it's not just payrolls, it's other things as well, suggests that there really is meaningful downside risk. I said there was downside risk then, but I think that downside risk is now a reality, and there's clearly more downside risk. So I think that's broadly accepted. And so that meant different things for different people. Some wrote down, almost everyone wrote down, supported this cut, and some supported more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. I mean, people have, you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. We endlessly discuss this between ourselves, and then we have a meeting where we put it all out on the table, and this is what you get. And you're right, there's a range of views in the dots, and I think that's, like I said, very unsurprising given the quite unusual, historically unusual nature of the challenges that we face. But let's remember, though, the unemployment rate's 4.3%. The economy's growing at 1.5%. So it's not a bad economy or anything like that. We've seen much more challenging economic times. But from a policy standpoint, the standpoint of what we're trying to accomplish, it's challenging to know what to do. There are, as I mentioned earlier, there are no risk-free paths now. It's not incredibly obvious what to do. So we have to keep our eye on inflation. At the same time, we cannot ignore and must keep our eye on maximum employment, which is those are our two equal goals. And you will see that there are a range of views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
Okay, Claire Jones, bit past your
Thank you,
bedtime
Archie Hall,
now.
the Economist.
Chairman Powell.
You
In there.
mentioned earlier
Hey.
that job creation was running
Earlier.
below your guess at its break-even rate. I'd be curious to hear a bit more about that and where you think the break-even rate
This is
is.
the first young guy I've ever seen here.
So there are many different ways to calculate it, and none of them is perfect. But it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. I mean, there's just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly, and that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point, and that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that supply and demand have really come down together so far, except now we do have unemployment ticking up outside, just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this level of this speedy decline in both supply and demand has certainly gotten everyone's attention.
Follow up, if I may. You mentioned the downside risk to employment a fair amount, but it's striking that measures of kind of activity and output for the third quarter, those that we have, seem pretty strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PCE numbers as well. How do you square those things? Is there a chance actually could be upside risk to the labor market if those activity measures are right?
Well, that would be great. We'd love that to happen. So I don't know that you see a big tension there, but it's gratifying to see that economic activity is holding in, and it's a good bit from consumption. It looks like consumption was stronger than expected, what we got earlier this week, I guess. And also we're getting, a fairly narrow sector is producing a lot of economic activity, which is the AI build out and business investment. So we watch all of it, and I would say we did move up. The median for growth for this year actually moved up in the SEP between the June and September SEPs. So, and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Nicole.
Still going. All right.
Hi, Nicole Goodkind with Barron's. Thank you for taking my question. Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
Housing is an interest-sensitive activity. So it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates. And that has been happening, and that'll of course raise demand. Lower borrowing rates for builders will help, builders will help supply. And so some of that should happen. I think most analysts think that it would have to be pretty big changes for it to matter a lot, big changes in rates to matter a lot for the housing sector. And the other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing. And then the last thing I'll say is, there's a deeper problem here. There's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage. Or a lot of places in the country just don't have enough housing for people, and all of the areas around metropolitan areas like Washington, for example, are very built up, and so you're having to build farther and farther out, and so that's where it is.
And just a quick follow-up. During the last SEP, or the press conference following the last SEP, you seemed to indicate that policymakers lacked conviction about their projections, and I'm wondering if you still feel that way.
Forecasting is very difficult even in placid times, and as I've mentioned before, forecasters are a humble lot with much to be humble about. So I think right now is a particularly challenging time, even more uncertain than usual. And so I don't know any forecaster anywhere, really. Ask any of the forecasters whether they have great confidence in their forecast right now. I think they'll honestly say no.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo
Chair
Finance.
Powell, she said a drink.
If you're cutting rates, why continue to reduce the
I like
size
her
of your
voice.
balance sheet, then pause the unwinding?
All right, Timo Gina.
Well, I think we're cutting the size of our balance sheet quite marginally now. As you know, with the balance sheet, we're still in an abundant reserves condition, and we've said that we would stop somewhat above an ample reserves level. That's where we are, and we're getting closer to that. We're monitoring it very carefully. We don't think that has at all significant macroeconomic effects. These are pretty small numbers moving around inside a giant economy. You know, the level of runoff is not very large. So I wouldn't attribute macroeconomic consequences to that at this point.
And at his recent confirmation hearing, Stephen Myron brought up that the Fed actually has 3 mandates from Congress, not just jobs and stable prices, but also moderate long-term interest rates. So what does Congress mean by moderate long-term interest rates? How should we understand that when we see the 10-year Treasury moving? And how do you think about this part of the mandate when policy choices like rate cuts or balance sheet reductions affect the long end of the yield curve?
So we always think of it as the dual mandate, maximum employment and price stability, for a long time, because we think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment. So we haven't thought about that for a very long time as a third mandate that requires independent action. So that's where that is. And there's no thought of, as far as I'm concerned, there's no thought of considering that, considering that we somehow incorporate that in as something in a different way.
Thanks, Chair Powell. Matt Egan from CNN. Sure. We recently learned that average FICO credit scores are down this year by 2 points, the most since 2009 during the Great Recession, and delinquencies are high for car loans, personal loans, credit cards. How concerned, if at all, are you about the health of consumer finances, and do you expect today's cut will help?
So, we're aware of that. I think default rates have been kind of ticking up, and we do watch that. They're not at a level, I don't believe they're at a level where overall they're terribly concerning, but it is something that we watch. Lower rates should support economic activity. I don't know that one rate cut will have, a visible effect on that, but over time, a strong economy with a strong labor market is what we're aiming for, and stable prices. So that should help.
Just to follow up, this rate cut is coming at a time when the stock market is at or near all-time highs, and some valuation metrics are elevated historically. Is there a risk that cutting rates could overheat financial markets, potentially fueling a bubble?
We're tightly focused on our goals, right? And our goals are maximum employment and price stability. And so we take the actions that we take with an eye on those goals. Separately, and that's why we did what we did today. Separately, we monitor financial stability very, very carefully. And, I would say it's a mixed picture, but households are in good shape, banks are in good shape. Overall, households are still in good shape in the aggregate. And I know that people at the lower end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture. We don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole picture, really looking for structural vulnerabilities, and I would say those are not elevated right now.
I can't believe it's still going. Okay, I was going to say it's been about an hour.
Hi, Chair Powell. Jean Young with MNI Market News. I wanted to ask about inflation expectations. You've said the Fed can't take the stability of inflation expectations for granted. You mentioned at the short run they've gone up a little bit. I wonder if you can talk a bit about that. And then also at the long run, I'm wondering, do you see evidence that the debate over Fed independence and the growing deficit is putting pressure on inflation expectations?
So as you said, shorter-term inflation expectations have tended to respond to near-term inflation. So if inflation goes up, inflation expectations will predict that it takes just a little while to get back down. Fortunately, throughout this period, longer-term inflation expectations, both break even in the markets, and almost all of the longer-term surveys, Michigan being a bit of an outlier lately, have been just rock solid in terms of running at levels that are consistent with 2% inflation over time. So we don't take that for granted. We actually assume that our actions have a real effect on that, and that we need to continually show and also discuss our commitment to 2% inflation. And so you'll hear us doing that. But we're, as I mentioned, it's a difficult situation because we have risks that are both affecting the labor market and inflation. Those are our two goals, and so we have to balance those two. When they're both at risk, we have to balance them, and that's really what we're trying to do. Your latter part of your question was about independence. I don't see market participants. I don't see that that's something they're factoring in right now in terms of setting interest rates. Thanks very much.
Gina, last question to Gina. We got skunked. We definitely got rug pulled on the Ginas. Like, Gina's gone. Asian Gina shut up once. Greena shut up once. Like, the real questions that we all should be asking is when Gina back? God, we miss her. Did you notice the questions have gone downhill? As soon as she left, straight downhill. It's all like questions you won't answer. It is what it is. This was by far the biggest, most important FOMC of our lives. Next month will be important. The months going forward will be important. But they'll maybe never be this big. We'll see. Price action was wild, but everything is roughly where we started. Bitcoin almost exactly where we started at the beginning of the stream. I would say is exactly where we started. We saw range highs, we saw range lows, just as we typically do in the FOMC. The dollar plummeted off the 25 cut, but then rallied higher and is now roughly back to where we started, as predicted. I'll say as predicted. Gold, really the biggest, craziest move. Gold very volatile during this interest rate decision, despite it being exactly what everyone expected. Oh yeah, I should probably like let you guys see the chart. My bad. Yeah, gold hitting all-time highs, come down. Biggest, most volatile move. Even broke actually that sweep of the low. Markets really reacted, maybe overreacted to what they expected to happen. I kind of thought that this would be a chiller vibe. Here's the dollar. A chiller vibe if we got 25 BPS, but man, no chill in the markets today. And no chill in the chat. You guys were awesome. You were absolutely awesome today. We had a ton of new subscribers, a ton of new people. If you're out there and you're new, you haven't seen us, subscribe. We're live here constantly, daily on YouTube. We're covering the FOMCs every month, the minutes. I want to take a moment to thank Market Cypher. Crypto Face in the chat here, making a guest appearance. Market Cypher sponsoring this live stream. You can use our limited time code 𝐒𝐶HPOW50, only available for the next 50 hours to get 50% off. Don't sleep on that. That's a deal. You see me using Market Cypher B every single day. It's time to check it out yourself. Man, I'm not going to be here Friday. I will be in Ohio. That's right, I'll be in Ohio. If you're in Ohio, let me know. I'll be in Ohio, but I'll be back next week. So I did set a new episode, a new free educational lesson to be published on Friday. Check that out when it publishes. Check it out. Make sure to watch it. Keep your eyes on, keep your notifications ready. Let's hype up that video. There's apparently a new hype mechanic on YouTube. If it lets you do that, please hype that video when it comes out. I guess it's like a new button. It's like and subscribe, and now it's like, subscribe, hype. I don't know. Anyway, man, sign up with Market Cypher. Jump in our Discord. It's free. I have no doubt that while I'm gone, price action will be insane. Like, it's like no question. As soon as I'm not going to be at the computer, it's going to get crazy. So I hope you guys enjoy what this week has in store. I don't even think this is the biggest move. I think we have a bigger move coming this week. We'll see. You guys are the best. I love you. Crown out.
Chairman Powell, money machine going bird. Chairman Powell, he ain't playing, this a blur. Gotta follow the data, ain't no time to err. Watch him speak now with that Tom Crown flair. Yeah, Chairman, he's the captain of the crew. Navigating through the markets, knowing what to do. Federal Reserve's in control, making moves. Keeping that money flowing so the economy can groove. Chairman Powell, making paper every hour. Chairman Powell, he got that money power. Data on his side, watch him rise and devour. Yeah, he's the chairman of the board, making moves that empower.